Good day, everyone. I want to believe you can hear me loud and clear. You're welcome to today's live stream. If you can hear me loud and clear, please drop a comment. Drop a comment if you can hear me loud and clear. Also confirm you can see my screen. How has been trading this week? Today is Wednesday. How has been trading? Hope it's been profitable. My week has been great. It's been great. It's been profit back to back. It's been profit back to back. How has been your week? Hope you're winning. Hope you're winning. You're welcome. You're welcome. Can you hear me? Can you see my screen? I'm waiting for your response. If you can hear me loud and clear, let me know. Let me know. Let me know. Let me know. I think towards the end of the class, I'm going to teach on risk and money management. When we are done analyzing the chart, I'm going to talk about risk and money management. Risk and money management. You need to be very good at managing risk. To be consistently profitable, you need to be very good. You must be a pro at risk management. And that is what most losing traders lack. That's what most losing traders lack. So I'm going to talk about risk and money management. Good morning, Mr. Debayo. Good morning, Mr. Sam. Okay, let's start the class. So we'll start by looking at the calendar. Today is Wednesday, the 9th or 10th of September, and we are expecting major news from the United States by 1:30 p.m. Core PPI and PPI will be released. That is production price index. It will be released by 1:30 p.m. So we should expect erratic price movement today. Should expect erratic price movement today. Okay. If you're considering trading the major currency pairs, you could wait for the news to be released before you execute trades on USD. You could wait, but if you see your technical setup in London session, you could execute a trade, okay, but you shouldn't aim for too much. If you're executing trade in London session, don't aim for too much, okay, and you should risk less. Don't go all in London session, okay. I've always advised when the major news is expected, you should risk, if you want to execute in London session, you should risk between 20 to 30% of your maximum daily drawdown. If that trade does not work out, you still have 70% of your daily drawdown to risk after the news has been released. That is how I trade. I'm a technical trader. So if I'm going to execute a trade before the fundamentals, I have to be very conservative. It's very important. Don't go all in. Don't go all in. Mr. Joseph, I can see you. Mr. Ebenezer, I can see you. Mr. Isaiah, I can see you. See, you guys are doing great and mighty things. I'm so happy you guys are eating it back to back. Good, good. Okay, so let's go to the chart. So what's the expectation on, let's see the expectation. The forecast is 0.3, the previous was 0.9. So they're expecting a decrease for core PPI and also for PPI. They're expecting a decrease from 0.9 to 0.3. So if the actual comes out negative, we should expect dollar to be bearish. If the actual comes out negative, we should expect dollar to lose value. Okay, so let's go to the chart. We'll start by looking at dollar index. The there's any pair you want me to analyze, let me know in the comment section. So this is dollar index. So we'll start by looking at the daily time frame. So you can see I applied average true range indicator. This is average day range indicator, and the period is 14. So let's see the average daily range. Average daily range is 62 pips. 62 pips. It means if you're buying or selling US dollar today, your target should be 60 pips. Your target should be 60 pips. That is what it means. It means that for the past 14 days, the average daily range for US dollar, for the dollar, is 61 pips. So if you are selling or buying the dollar today, your target should be between 50 and 60 pips. So if the daily range is between 50 and 60 pips, and you see a buy setup, your stop loss should not exceed 30 pips. Your stop loss should not exceed 30 pips. So you'll be risking 30 pips to make 50 to 60 pips. That's like 1:1.5 to 2 risk reward. Okay, so the average daily range is 61 pips. Okay, yeah, okay. So you can see yesterday candle closed strongly bullish. That tells me that today dollar will be bullish. Okay, that tells me dollar would be bullish because yesterday candle closed strongly bullish and it closed at a fair value gap. There was a fair value gap here. I think it just filled. Okay, if you go down to lower time frame, I think it just filled a fair value gap, and you can see that price is at a discount area. You don't sell at discount, you look for buy opportunities at discount area. So if you go down to 4 hour, I'm sure there's a fair value gap here, price filled on a 4 hour or 1 hour time frame. Let's see. There's a fair value gap, it's just filled. Okay. So we had this fair value gap here on a 4 hour time frame, a very tiny fair value gap. You need to shine your eyes. There's a fair value gap here, but let's go down to lower time frame so that you can see the fair value gap clearly. Let's go down to lower time frame. Where is my vertical line? Okay. Okay, so this is 1 hour time frame. Okay. So you can see this fair value gap on 1 hour. This fair value gap. That could be the reason for the pullback. Okay, that could be the reason. Let's see. That could be a reason for the pullback. Let's confirm that. Let's see. Okay, so you can see what we have here. You can see. So price filled that gap. It even went below it, and at the moment it is trading above that fair value gap. This tells me that demand is higher than supply. This tells me that demand is higher than supply. So for today's market, technically, I am bullish. Remember, a major news will be released by 1:30. So technically, I am bullish. I am bullish for dollar. But if the news comes out negative, then we should expect sales on DXY. If the news comes out negative, we should expect sales on DXY. Okay. So that's my take on DXY. I'm bullish on DXY. I'm bullish on DXY. Okay, so let's see yen basket. Yen basket. So let's start with the daily. So So this was yesterday candle. So yesterday candle swept the high of last Friday. This was Friday, Monday, Tuesday. Okay, so it swept the high of last Friday, and you can see we had a fair value gap here. Last week there was a fair value gap that was created here, and after this retracement on Friday, they know most retail traders would have executed sell after the formation of this candle. Most retail traders would have executed sell, and their stop losses will be residing at this high, at the high of this candle, or a few pips above the high of that candle. So what happened yesterday? On Monday, price went to sweep the liquidity residing at the low of Friday. That was on Monday. Then on Tuesday, price pulled back up to sweep back side. So the first went for sell side liquidity. Have bought. After the formation, we had a doji, we had an inverter. Traders were executed buy after the formation of this pattern. And what they did on Monday was to first go for the stop losses. You can see they swept sell side liquidity before going for the buy side liquidity, and that they have achieved. And with that, let's go down to 4 hour. So if we are able to identify a bearish reversal pattern on a 4 hour time frame after the close of yesterday candle, then we should expect yen to be bearish. We should expect yen to be bearish if we are able to identify a bearish reversal pattern on 4 hour time frame or 1 hour time frame. So let's go down to 4 hour and see what we have. So you can see the pattern we have on 4 hour time frame yesterday. Can you see this? We had a shooting star. We had a shooting star on 4 hour time frame after price swept the liquidity residing at this high. You can see that. So the sell started yesterday. The sell started yesterday. Now, if you want to work with Fibonacci, you would apply your Fibonacci from this swing low to this swing high. We want to see price pull back to a discount area. So JPY is bearish at the moment. Sweep this relative equal low. It might sweep this relative equal low today. Okay, so I'm bearish on JPY. Now, if you have not started selling JPY, you can see it has created a fair value gap here. So it might want to come and fill this fair value gap before it continue with the sell. So if you don't have a trade on JPY, currently buying GBP JPY, I took that trade. I think it was yesterday I took the trade, GBP JPY. I'm buying GBP JPY. Okay, so if you are not selling yen at the moment, you could wait for price to pull back to this fair value gap before you sell. That is my take on yen basket. I am bearish on yen. I am bearish on yen. Okay, I am bearish on yen. Gold, definitely we'll analyze gold. We'll analyze gold. Okay, we'll analyze gold. So now let's look at currency pairs, GBP USD. Like I said, my bias for the dollar is bullish. Okay, my bias for the dollar is bullish, but right now I'm buying GBP USD. I'm buying GBP USD. Okay, but I expect dollar to be bullish. But right now I have a trade on GBP USD. I am buying GBP USD, and the reason for the buy, let me tell you why I am buying GBP USD now. Okay, let me tell you why I'm buying GBP USD. I dropped the analysis on the group earlier today. Okay, though the full video was dropped in the private community. The full analysis was dropped in the private community, and I believe those in the private community are also buying. They've executed buy. So yesterday we had a shooting star candle after the market swept the liquidity that was residing at this high. Okay, the market swept the liquidity residing, I think, yeah. Okay, all these highs, relative equal highs, all these highs were swept. And after sweeping all this liquidity, we had a shooting star, which indicates change in trend from bullish to bearish. Now, most retail traders would have executed sell after the formation of this shooting star. And where would they have their stop loss? Their stop loss is residing at the high of yesterday candle. So the high of yesterday candle is our area of liquidity for today's market. It's our area of liquidity for today's market, and the low of yesterday candle is our sell side liquidity for today's market. It's our sell side liquidity for today's market. And you can see what happened this morning. The first thing they did was to sweep the low, the sell side liquidity. That was the first thing they did. They've swept the liquidity, and after sweeping the liquidity on the sell side liquidity, let's go down to 4 hour and see what's happening on 4 hour. Good. So you can see what we had here. After they swept the liquidity on the sell side liquidity, which was residing, I think, at this low or this low, they swept that liquidity, and look at the pattern we had. This is a bullish reversal pattern. You see, this is a bullish reversal pattern. That is the reason I am currently buying GBP USD. That's the reason I'm currently buying GBP USD. Also, if we apply Fibonacci, this is 4 hour time frame, from this swing low to this swing high, price pulled back to a discount area. Okay, price pulled back. You can see price pulled back to a discount area. Candlestick, this bullish reversal pattern we had there was below level 50. You can see that. So price pulled back to a discount area. Okay, and also you can see we had a fair value gap here. You can see we had a fair value gap here on 4 hour, which could also be the reason for the retracement. You can see this fair value gap here. There is a fair value gap here. Or let's go down to lower time frame. Let me go down to lower time frame. Gap here, that price, I think price field. Let's go down to 1 hour. So you can see the fair value gap on 1 hour. Can you see it? Can you see it? So price pulled back to fill this fair value gap. You can see, and after filling the fair value gap, you can see the several bullish reversal pattern that formed after it filled the fair value gap. You can see the reason for my buy now. Okay, so this fair value gap, and we had a resistance which became a support. That is the reason for my buy. Now, after this impulse move, you can see the shift in market structure occurred. At this point, there was a sweep of liquidity. Then a shift in market structure occurred at this point. And after a shift in market structure, price is expected to pull back to a premium area. Price is expected to pull back to a premium area. So I'd like to see, my expectation is that GBP USD will pull back to this premium area. Price is expected to pull back to this area. And you can see at this premium area, we had a fair value gap here. We had this fair value gap here at this premium area. You can see that we had this fair value gap here, and last night there was an attempt to fill this fair value gap. Yesterday there was an attempt to fill this fair value gap, and I believe after the formation of all, you can see we had a doji here, and we had this engulfing pattern. We had this engulfing pattern. I believe most retail traders would have sold after the formation of this pattern. And where would they have their stop loss? Their stop losses is residing at the high of this candle. Most traders will set their stop loss here. Some will set their stop loss using the high of this doji. Okay, so there's a high probability they will come and sweep the liquidity residing at this previous high. First, they will need to sweep liquidity residing at the Asian session. They've not swept the liquidity residing. The liquidity residing at the Asian session is at this high, They will need to sweep that liquidity. Okay, so that is the reason for my buy on GBP USD. Now, I would consider selling if the news comes out positive for the dollar. If the news is positive for the dollar, I would consider selling if price pulls back to this zone. I would exit my buy at this zone and sell from that zone. If the news is positive for the dollar, I would sell after price fills this fair value gap, and by that time, I should have hit TP on my buy trade. I should have hit TP on my buy trade. Once the market moves in my direction 30 pips, because I know I'm trading against the trend, once the market moves in my direction 30 pips, I would adjust my stop loss to break even. Okay, I would adjust my stop loss to break even. Once it moves in my direction 30 pips, I'm taking my stop loss to my entry level. So my bias for GBP USD today is still bearish. It is still bearish. Okay, so this buy is a pullback trade. Okay, it's a pullback trade. That is why my high is on the chart. Once it moves in my direction and I'm in good profit, I'm going to adjust my stop loss to break even, because anything can happen when you're trading pullbacks. Anything can happen. The trend can change anytime. Okay, so that's my take on GBP USD. Let's look at Euro USD. Euro USD is the same. If you are willing to risk, or you're willing to lose some funds on GBP or Euro USD, you could buy Euro USD now. You could buy Euro USD now. Okay, you could buy Euro USD if you're willing to take some risk. You could buy Euro USD. We had the swept liquidity residing at this low. This should be the low of Asian session, I guess. Yeah, this should be the low of Asian session. They've swept that liquidity. And what do we have here? We had an AMA. And after the formation of that AMA, what do we have on 15 minutes time frame? Let's say 15 minutes. Let's see. Okay, so we had an AMA here too on 15 minutes time frame. A resistance was created here. Now this retracement here, I think if you go down to lower time frame, we had a fair value gap on a lower time frame, 5 minutes or 1 minute. That is the reason for this retracement. That is the reason for this retracement. Okay, so let's go down to 15 minutes. Okay, and let's see 1 minute. Let's see 1 minute. There should be a fair value gap. Can you see the fair value gap? This is the reason for the retracement. Can you see it? This fair value gap, the gap here is the reason for the retracement. Let's see what happened when price filled that gap. You can see there was a strong rejection from that zone. You can see it. A strong rejection from that zone, and the market is trading above that zone right now. That tells me demand is higher than supply. And when demand is higher than supply, price is expected to go up. I don't need an indicator to tell me this. I don't need an indicator. The best indicator is your highs. The best indicator is your highs. Okay, so that is it for Euro USD. I'm still very bullish on Euro USD. Maybe after the news, I could, if I see a sell opportunity, I will take it. That's if the news is positive for dollar, I will sell Euro USD. If the news comes out positive for dollar, I would sell. Okay, so Euro USD is likely. So let's apply our Fibonacci. Apply your Fibonacci from this swing high to swing low. You want to see price pull back to a premium area. You cannot sell Euro USD price. You tell me you want to sell Euro USD market price, so you don't know what you're doing. You don't know what you're doing if you decide to sell Euro USD from the current market price. Why would you want to sell? See 4 hour. This is 4 hour. If you apply your Fibonacci from this swing low to this swing high, I'm sure price has pulled back to equilibrium. Okay, it has pulled back to equilibrium, and you can see we had this fair value gap here. Can you see the fair value gap? After price filled the strong rejection from that, so you can't tell me you want to be selling at a discount area. You cannot be selling. You cannot be selling. You know what you're doing. This is where price started dropping. This is where price started selling. If you didn't sell from this point, you have no reason to sell from this point. You have no reason to sell. If you want to sell, if you insist that your bias for today is bearish, you should wait for price to pull back to a premium area. A premium area. Wait for price to pull back. Isaiah, I can see your message. Don't worry, I'll analyze New Zealand USD. Once I've given you the bias for dollar, you should know the direction for other for the major currency pairs. Once I've analyzed DXY, dollar index, you should know the direction. Okay, so if I say DXY is bullish, major pairs that have dollar as the counter is sell. Major pairs that have dollar as the counter is sell. And if my analysis on DXY is bearish, then you should buy pairs that have dollar as counter. Okay, so I don't need to analyze all the USD major currency pairs. Once I analyze DXY, you should know the direction for all major currency pairs. Okay, so that's my take. So expect, if you want to sell, wait for price to pull back. Hopefully before the news be released, price would have pulled back to this area. Then if the news comes out positive for dollar, we sell it. We sell it. Okay, now when the news gets released, don't rush in and start selling, even if it is positive for the dollar. Don't jump in and start rushing. Wait for because if you jump in immediately the news is released, sometimes your stop loss will be used as liquidity. So I always advise that you should wait after 1 hour or 2 hours. So today's news is by 1:30. You should be looking for your setup by 3 or 4 p.m. That is when you should be looking for your setup. That is when you should be looking for your setup to sell. Okay, I hope that is clear. I hope that is clear. Okay, so let's look at if you have any question or any pair you want me to analyze, let me know in the comment section. Someone said gold. That's from Chichi. Yeah, gold. Okay, NZD USD. So let's look at gold. Let's look at gold. XAU gold. Gold, 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 gold. Gold, gold, gold. What's happening on gold? What's happening on gold? Gold has been bullish for. I don't advise that you buy gold for now. I don't advise that you buy gold. Gold, as far as I'm concerned, is overbought. Gold is overbought. If you buy gold, you're just gambling. As far as I'm concerned, if you buy gold, you are just gambling. You're just gambling if you buy gold. You cannot buy gold from the current market price. You have to wait for price to pull back. There should be a strong retracement on gold before. This is where you should be considering buying gold. This is where you should be considering buying gold. Okay, this is where you should be considering. That is if you want to risk buying. If you want to risk buying, not from the current market price. Okay, so yesterday candle closed as a shooting star, which indicates change in trend from bullish to bearish. Change in trend from bullish to bearish. Now, after the close of yesterday, I'm sure if ever gap was created on a lower time frame, 4 hour, 1 hour, or 15 minutes time frame, and that could be the reason for the current pullback we are seeing in the market. That could be the reason for the current pullback you're seeing in the market. Okay, so on 4 hour, do we have a fair value gap here? No fair value gap here. Let's go to 1 hour. Let's go to 1 hour. And I think also on 4 hour, I think it's filled. It did fill this gap, I think. That could also be the reason for the retracement. Yeah, I think it filled this gap. I think this fair value gap it's created here. I think it filled that gap. Yes, it did. And a bullish reversal pattern formed. That is why it is bullish at the moment. That is why it is bullish at the moment and is going to fill the sell side imbalance, buy side inefficiency. Let's see on 1 hour. There is a fair value gap it wants to go and fill. There is a fair value gap it wants to fill. Okay. So let's go down to 15 minutes. Okay. So on 15 minutes, you can see we have this fair value gap here. This will be a very good area to consider selling if you want to sell. This is where you should consider selling. Okay. So if you want to risk buying, you could wait for price to pull back to this zone for buy, sell this zone. Gold is at no man's land at the moment. It's no man's land. You shouldn't buy now. You shouldn't sell now. These are the zones you should be considering buying or selling gold. Okay, gold right now is at no man's land. You could have bought after the function of this binding button. You could have bought, okay, while you target this fair value gap. Now price has moved. You cannot buy from this point if you didn't buy from this point. If you had bought from this point, by now you would have adjusted your stop loss to break even. No risk on the trade. Why you hope that the market will hit your your target, which is this fair value gap. So you cannot buy now if you didn't buy from this point. So that's my take on gold. Look for sales from this zone. You have missed the buy opportunity here. You could look for sales. But if price breaks out from this zone, breaks out from this resistance, then we should expect more buys on gold. But once price gets to this zone and a bearish reversal pattern forms inside this zone and closes below it, then you should look for sell. You should look for sell. And if you are selling from that zone, your stop loss should be the high of this candle. I hope that is clear. So that's my take on gold. Don't buy now, don't sell. Okay, don't buy, don't sell. Okay, so let's look at NZD USD. If you have any question, any pair you want me to analyze, let me know in the comment section. So let's start with the daily time frame, same pattern. You can see the pattern we have here is similar to what we have on Euro USD and GBP USD. And that's because they are positively correlated, okay? 70 to 80% of the time, all these pairs, they will move in the same direction. Okay, so liquidity that was residing, this was Monday, Tuesday, Wednesday. They swept the liquidity that was residing at the high of Monday candle yesterday. And also, they had to use the opportunity to fill this gap that was created here. You can see this gap. You can see this gap that was created here. They had to use the opportunity to fill this gap, and there was a strong rejection. So we should expect NZD USD to drop to a discount area. It could drop to now. They might also use this the high of yesterday as liquidity. If there is a fair value gap above this high, they might use it as liquidity. Let's confirm. If there's a fair value gap above that high, they might use it as liquidity. Let's see. So you can see here on 4-hour time frame, we have fair value gap here. So they might use today's high as liquidity. They might use today's high as liquidity. So if you want to take any trade on NZD USD, if you want to sell, your stop loss should be at this point, your initial stop loss. That is, if you're going to sell before this is released, your initial stop loss should be at this level, which is how many pips from the current market price. That's about 50 pips. Yeah, that's about 50 pips from the current market price. Okay, so because of this fair value gap above the high of yesterday candle, they might use yesterday high as liquidity. Okay, they might use yesterday high as liquidity. So you need to wait for the liquidity to be swept before you look for your sell opportunity. All is likely going to play out before the major news or after the news is released. So you can see this high, and there's a high probability they will sweep the liquidity. There's a high probability they will sweep this high. There's a high probability because of this engulfing candle here, this breakout from this support. Most retail traders would have executed sell, and their stop losses is residing at this high, which is very close to the high of yesterday market, which is very close to the high of yesterday market. You can see. So there's a high probability on NZD USD. This liquidity might be swept. This liquidity might be swept. Okay, so look for sales. Look for sales. Look for sales. If you want to take the risk buying from this point, but I think the risk reward is poor. The risk reward is very poor. So I would not advise that you take a buy now. You should have bought earlier. Okay, you should have executed buy. This is where the buy started from. So if you want to buy, you could wait for, you can see this fair value gap here has not been filled. So if price pulls back to this fair value gap, okay, you could consider buying. Okay, consider buying, but I'm not sure. It's like they will go and sweep liquidity before coming back for this fair value gap. Because if you look at the bullish momentum is very strong right now. The bullish momentum is very strong. So there's a high probability they will go sweep the liquidity residing at this high. before coming for this fair value gap. So if you are selling after liquidity has been swept, this fair value gap should be your target. This fair value gap should be your first target. You see what played out here? There was an attempt to fill this fair value gap at this point. You can see there was an attempt to fill the fair value gap. I see this as a trap for retail traders. Most retail traders are buying right now, and their stop losses will be residing at this low. Stop losses are residing at this low. So there's a high probability they're coming back to this zone later. They are coming back to that zone later. Any question, please give the video a thumbs up if you haven't done that. And if it's your first time joining the live stream, first I want to appreciate you for joining. Please do subscribe to the channel so that anytime I come on live, you get notified by YouTube. Subscribe to the channel, subscribe to the channel. Subscribe to the channel. I said I'm going to talk about risk and money management. Okay. Is there any other pair you want me to analyze before I start teaching on risk and money management? You need to be very good at risk and money management to make money in this market. If you're not applying proper risk and money management, you are gambling. You are gambling. You don't know what you're doing. You are gambling. If you are not using stop losses, you are gambling in the market. You are gambling in the market. You must be very good at risk management. Okay, let's just spend some. If there's any question, please let me know. Let me just talk a little on risk and money management. Let me just teach on risk and money management. Okay, so before you execute a trade, you need to know the capital risk. Before you take any trade, you need to know the capital risk. Okay, your capital risk must be defined. You should also know your market risk. These two things, very important. Define your capital risk and the market risk. Capital risk is how much you're willing to lose on a trade. What is the dollar amount you're willing to lose on every trade? Okay, what is the dollar amount? And this should be defined immediately you deposit, you fund your trading account. Even before you fund your trading account, you should have a plan. You should have defined how much you're going to lose on every trade you execute in the market. Then the market risk is your stop loss price. That is the difference between your stop loss and your exit price. The difference between your entry price and your stop loss. That is your market risk. That is your market risk, okay, which is in pips. Okay, so let's say you're trading with, let's say $1,000. Now, you are advised not to risk more than 2% of your capital. Now, for those of you trading $50, $100, open a cent account unless you want to take very high risk. If you want to stick to 1 to 2% of your capital, if you're trading with my strategy, with my own system, with my strategy, if you're trading with my strategy, $50, $100, $200 should be a cent account unless you want to take high risk. Okay, unless you want to take high risk, then you should open normal accounts, normal standard accounts. But if you want to manage risk, you want to stick to 1% to 2%, you should operate a cent account. Account from $500 can operate normal accounts. That's if you are trading with my own system, okay? Because my system, the market risk is between 30 to 50 pips. 30 to 50 pips. Okay, I ensure that my stop loss does not exceed 50 pips, maximum 50 pips. Okay, 50 pips. So if you have $100 and you want to trade my strategy, if you have $100, you cannot apply 2% on $100, right? 2% of $100 will be $2. And if you use the minimum lot size, which is 0.01, on every trade, you'll be losing between 3 to, that will be $3. If the risk is 30 pips, if the market risk is 30 pips, you'll be losing $3, which is 3% of $100. 3% of $100. If the risk is 50 pips, if the market risk is 50 pips, you will lose $5, which is 5% of your capital. But if you operate a cent account and you are expected to risk $2 on a trade, and the risk on a trade is $30, you can apply the lot size of 0.06. This is the lot size you would apply on a cent account to ensure that you don't lose more than the 2% of your capital. Okay, this is the lot size you would apply, 0.06, to ensure that you don't lose more than $2 if the trade goes against you. Okay, now if you're operating with $1,000, 2% would be 2% would be $20. Okay, 2% will be $20 on every trade. Never lose more than 2%. That should be your maximum daily drawdown. Most people will tell you don't lose more than 2% on every trade. What that means is that if you execute 5 trades in a day and you are risking 2% on every trade, that means for that day you are risking 10% of your account. You'll be risking 10% of your account. So your maximum daily drawdown should not exceed $2. It should not exceed $2. If you see the trades, you see that I opened several trades. If you check what I posted yesterday, you will see that I opened several trades. All those trades you see does not exceed 2% of my capital. It doesn't exceed. I can have 10 trades. I ensure that those 10 trades, if you total everything, if the trade goes against me, you don't lose more than 2%. It does not exceed that 2%. Even if I open 50 trades, those 50 trades, if it goes against me, I ensure that it does not exceed 2% of my capital. Okay, so for those of you operating with $100, $50, I would advise you open a cent account. Open a cent account, because sometimes the first trade you would execute sometimes might not play out as expected. You might lose the first trade. Are you getting me? You might lose the first trade. The trade might not play out as expected. Are you getting me? It might not play out as expected. But if you have lost so much on the first trade, if you have lost much on the first trade, you will not have the confidence to execute another trade when your setup shows up. You will not have the confidence to execute another trade when your setup shows up, because you have risked so much on the first trade. I hope you're getting me. You have risked so much on the first trade. But if the first trade does not work out and you still have funds that you can trade with for that day, okay, let's say the first trade, if you are risking $2 on the first trade, you can risk $1. If that does not play out, your setup shows up, you take another trade, that one might play out, and with that one, you'll be able to recover the loss you made on the first trade. Are you getting me? That's why you need to have funds that would afford you the opportunity to at least take 2 trades in a day. 2 trades in a day. If the first does not work out, the second would work out. That's why I advise that you should operate a cent account. If you have less than $100 or $200, operate a cent account. Okay, so you should also know the lot size to apply on a trade. Know the lot size to apply on a trade. For example, let's see Euro USD. Like I said, there's a buy opportunity on Euro USD. So I already took a buy trade on Euro USD. Okay, I already took a buy trade on Euro USD. Now, if I'm buying Euro USD, this is where my stop loss will be. This is where my stop loss will be, because I know anything that will make price break this low, then we should expect more bearish move. That means it's coming to fill this fair value gap here. That will be the next target if it breaks out. So this will be my validation level. This is my stop loss level. This will be my stop loss level. So now the market is at 1.1712. 1.712. So if I decide to buy from this point, that will be about 30 pips. So my market risk on this trade is 30 pips. And let's say my balance is $1,000, 30 pips. So the market risk is 30 pips. So what lot size would I apply on this trade? What lot size? You don't use the same lot size on every trade. The lot size will differ depending on the market risk. Okay, the lot size will differ on every trade. Okay, you can't use the same lot size you apply on 30 pip market risk on a trade that has 40 pip or 50 pip. So the lot size would vary. Okay, so this is 30 pips and I'm willing to lose $20. All I need to do is just divide my capital by 30. It's like you want to share $20 amongst 30 persons. So each person will go home with, I think this should be 0. Let me use my calculator. 20 divide 30. Here's my, let me get my calculator. 20 divide 30. This is 0.66. Okay, so the lot size I would apply, or I should apply on this trade, will be a lot size that will give me 66 cents per pip. 66 cents per pip. So what lot size will give me 66 cents per pip? That will be 0.06. 0.06 lot size is what will give me 66 cents per pip. Okay, so after you've gotten this value, all you need to do is multiply this value, multiply it by 0.1. That will give you the lot size. It's simple. Whatever value you get after dividing your capital risk with the market risk, multiply it by 0.1, that gives you the lot size to be 0.066. But you can't find 0.066 on the platform. What you would find is 0.06. That is the lot size you would apply on that trade. That is the lot size you would apply on that trade. If the risk is 50 pips, the lot size here will be 50. 20 divide 50. This will give me 0.1. I think I'm correct. 0.1. So the lot size I would apply on this trade, no, that should be 0.04. That should be 0.4. I hope I'm correct. 20 divide 50. Yeah, that should be 0.4. That should be 0.4. Then multiply 0.4 times 0.1. That should be 0.04. That will be the lot size. 0.04 lot size. Okay, that will be my lot size. Now, when you execute a trade and the initial risk on that trade is, let's say, 40 pips. Let's say the initial risk you took on the trade is 40 pips. Once the market moves in your direction, 40 pips, you should reduce your risk on that trade. Once the market moves in your direction 40 pips, for example, if I go to Euro USD now, let's say I took my buy from this point. Let's say this is my entry. Okay, this is my entry. So I want to adjust my stop loss to break even when the market has moved in my direction 40 pips, break even. So what I need to do, if this is my entry, 1.1698 plus 40, that will be 1.1738. So 1.1738. At this point, you can see 1.1. This is where I'm going to, once the market gets to this level, I'm going to adjust my stop loss from this point to this point, which is my entry, break even. Or I could adjust it maybe 5 or 10 pips above my entry. That is trailing stop. That is trailing stop. Most people, after making good profits on a trade, they leave their stop loss at the initial level, and at the end of the day, the market pulls back to hit their stop loss. That is not wisdom. That is not wisdom. If you have made good profit on a trade, you should adjust your stop loss. You should adjust your stop loss. Don't wait for price to pull back and hit your stop loss where it was. It doesn't make sense. It doesn't make sense. Okay, so that is trailing stop. That is trailing stop. Okay, that is trailing stop. So any question on risk management? Any question? Do you have any question on risk management? If there's any pair you want me to analyze before we end the class, let me know. Let me know. Risk management is not rock science. It's very simple. It's just that many people don't want to apply proper risk and money management. They don't want to lose in the market. That is why they don't apply proper risk and money management. If you're trading Forex, if you're not willing to lose money, don't trade Forex. Forex trading is not for you. Forex trading is not for you. When I send signal out, sometimes when I send signal out, I will ask them, are you willing to lose your money? If you are willing to lose your money, execute this trade. If you are not willing to lose your money, don't take the trade. Don't take the trade. If you are not willing to lose money in Forex, Forex trading is not for you. It's not for you. Trading is business. And if you don't want to start a business, if you are someone who is not willing to take risk, you cannot start a business. You cannot start a business. Many people prefer 9 to 5 because they are not willing to take risk. They are not willing to take risk. So if you are not willing to take risk, just go for 9 to 5. Get a job. But if you want to take risk, if you want to do business, okay, trading is for those who are willing to take risk. You must be willing to take risk if you want to do any business. Trading is a business. Any question? Do you have any question? I think that will be all for today's class. Do you have any question? If you have any question, let me know. On risk management, let me know. Or you have any pair you want me to analyze, let me know. I hope you all can hear me. I hope you all can hear me. Any question? Any question? I need to go and watch my trades. I need to go and monitor my trades. I need to go and monitor my trades. I should be in good profit right now. I should be in good profit. Wow. GBP USD is going well. Euro USD is going well. GBP JPY also is going well. Is going well. I'm in good profits on those instruments. Good profits on those instruments. Any question? Any question? Any question? Any question? So since there are no questions, that will be all for today's session. That will be all for today's session. I appreciate every one of you for your participation. I might come on live by 1:15 before the news. I might come on live. I will drop the link later on. Let's see how the market will react to PPI between 120 125. I might come on live if I'm available. I'll come on live. So stay tuned for that class. Wish you all a profitable trading day. Bye for now. Please give the video a thumbs up if you haven't done that. Give the video a thumbs up.